Asia, and what do we have there? Well, thankfully for us, Asian markets are responding this morning. Japan is looking stable. Check on SGX, 95 points up. So, Indian markets, they added about 100 points. Nifty yesterday added about 100 points. And we are in for another big bang or a grand open. So, what a difference sometimes 24 hours can make. Yesterday it was all about rupee and how rupee would disbalance equities in the near term. But despite a weak rupee, because of global stability and because of one important decision on gas price hike, SGX is off to a flying start. So things are looking stable. And after last week's financial Armageddon, things have settled. Globally, things are down, and some key Fed members are really trying to send a strong signal across to global money managers that one should not conclude that US Fed will tighten anytime soon. Tightening by US Fed is subject to data, so data is something what one should monitor going forward. Jeff Lewis, global market strategist with JP Morgan Asset Management, he joins us live from Hong Kong. Jeff, good morning. Thank you for joining us. Jeff, are you getting a sense that US Fed is now clearly trying to send a signal across that one should not read too much into last week's Fed communication?
Oh, yes, I think so. I think Bernanke's comments were misinterpreted. He was basically given a fairly gentle tapering scenario. I mean, not really starting until late this year, and then tapering gently all the way through the first half of 2014. But I think, nevertheless, it was something of a psychological shock to markets, and there were so many carry trades that have been used to this accommodation that they suddenly woke up to the fact that it couldn't carry on forever. So I think whilst the Fed might have been surprised at the virulence of the initial reaction, they'll be rather glad that they've got it out of the way and that they're now getting markets to focus on the fact that there won't be ultra easy monetary accommodation forever and ever, that it must come to an end soon.
Jeff, do you think after the overreaction, as most market experts are calling it, we're now going to see some significant recovery build into equities?
Well, we've seen a stabilization. We've had quite a sharp drop. Nothing fundamental has changed, so I think it was an overreaction. I think people will be watching the U.S. data pretty closely. We believe it will improve as we progress through the year. I don't think we'll have an immediate rebound to get back to where we were. I think quite a lot of credit markets now are looking actually quite attractive. I think they were oversold, looking at the spreads in emerging market debt, for example. I think institutional investors, they are taking a longer view. I think what we've seen is that we've had quite a bit of retail money has been shaken out of the emerging market debt funds and the high yield funds. That was something that Jeremy Stein, the New York Fed, was warning earlier in the year, that that some of these had become crowded trades. So yes, it's stabilization, but I think the markets will remain nervous and cautious. I don't think they're going to reverse course and say, oh, everything's wonderful.